In this video, we're going to be looking at or making some observations around areas of what we consider to be extremes or areas of major divergence in relationships between some market variables and some economic data. And clearly one of those areas of extreme has been in the sell-off in the bond market over recent months. It may not seem extreme in terms of levels, but certainly the speed of the move has been very extreme. So let's just maybe start with just a recap of what has happened in the market over this sell-off. And so if we open up the bond sell-off page, so what we're looking at here is this is just showing the bond sell-off over different periods. I'm going to turn your attention to the Australian bond market, which will come up shortly. And here, this shows the movement in the 10-year bond yield from the lows in the latter part of November that we put down as the low. So it doesn't look that extreme in the overall scheme of things, particularly when you compare it to other bond market sell-offs, about a 90 to 100 basis point sell-off, well short of what occurred, of course, during 1994, which is really the outlier over this sort of period from about 1988 onwards. But that probably hides the real story behind that, because we know the index today is a lot longer duration than it was in 1994. And so when you look at the returns from the overall index, you can see the black line is the most recent sell-off. So the loss, as we saw in February, was particularly extreme. The market had lost about 4%, so bonds had returned -4 since November. That's since improved slightly, but it's still down about 3%, the overall index, from where it was in the latter part of November last year. Again, still well short of what occurred during the 1994 sell-off, but savage nevertheless. So if we just now go over and have a look at some of the areas of what we see as some extremes in markets, and clearly, when you look at relative strength in indexes for various bond markets, you can see that this is for the US bond yield. It's got an RSI sort of sitting up well above the traditional 70 level, sort of peak levels, suggesting, as we've seen in the past, that these sort of peak levels in the relative strength index are often associated with a sort of a peaking process. Doesn't necessarily mean there's no further upside, but it certainly has often highlighted a process of peaking in bond yields. And likewise, in the Australian example, you can see the same here. Very extreme reading a few weeks ago. It's since come off a little bit, but still quite extreme. So, just certainly on a very simplistic sort of technical backdrop would suggest that these extremes are likely to be a precursor to a period of sort of sideways movement, possibly a slightly lower from here. What other areas extremes are we seeing in the bond market? Well, if you look at the Australian yield curve, I find this quite interesting, the bottom right-hand chart here. The yield curve, the 10s, 2s moved up to about 170, 175 basis points in the sell-off. And that pretty much is the peak level. It has got up to about 200 basis points, but pretty much in the 90s, 2008-9, the recovery sell-off again in sort of 13-14. The yield curve doesn't really get that much steeper, and so one might suggest that even though the bond is only at sort of 1.7, got to 1.9, that in a yield curve sense is looking fairly extreme. And the other one, of course, is just looking at implied inflation expectations, and I'm looking at the US market here, and what we're doing is comparing 5-year implied inflation expectations to 10-year implied, the difference between the two. And what we're trying to capture here is the extent to which the market is forecasting a more of a cyclical rise in inflation as opposed to a longer term structural increase in inflation. And that sort of bears out in this chart to some extent, where 5-year implied inflation expectations currently sit around about 2.5. The market is pricing is implying that in the 5 years subsequent to that, so that's years 6 to 10, inflation will fall back to sort of 2.1 or thereabouts. So they are projecting higher inflation in the cyclical sense, the shorter term, returning to something like target over the longer term. But that's not the only story in bonds and the only area of divergence, and obviously this is part of the concern in bond markets at the present time, is the fact that there is still significant divergence between bond yields and certain economic indicators. And one of the measures we look at, and this is more a case of eyeballing the relationship here. This is the ISM index, which in the US currently sits at around about 60, and the bond yield really has only started to try to narrow that gap. And broadly, they tend to follow as you'd expect over cycles. So there's a big gap here. It's not suggesting that they move anywhere near these sorts of levels, but what it is saying is that there's a big divergence, something that we might expect to be narrowed somewhat over the coming quarters. Another area of divergence, of course, is probably more importantly, is in a more of a medium, longer term sense, is this relationship between bond yields, nominal bond yields, and trend nominal GDP growth. And in the US, you can see the red line is trend nominal GDP growth, currently sitting at around about, we estimate 3.75 or thereabouts. Bond yields sitting down at 1.5 are a long way below, and in fact, not far off their highs or the most significant divergence. And of course, this divergence of bond yields being below sort of trend growth since sort of 2002, and particularly since 2008, has been one of the reasons perhaps why growth has been a strong performer relative to value. Now, I mean, this relationship does tend to hold over a long period of time. So for the bond market bears, this divergence might suggest that there's a lot of upside in bond yields, possibly up to sort of 3.5, 3, 4, just returning to the old relationship. We'd be a little bit cautious about expecting that. But nevertheless, this is one of the reasons why bond yields are seen as quite risky in the current environment. I want to now turn your attention closer to home, and these are more economic variables that are showing some significant divergence. And the first one, I'll just focus in on this, is just the relationship between housing finance and house prices. Now, in Australia, housing finances has really strengthened quite considerably over the past 6 to 9 months, probably, I think we'd say. It's up about 45% on a year ago basis. And obviously low interest rates and lower mortgage rates are supporting that. More recently, a bit of a recovery in employment, but also, of course, the home builder scheme is adding to that. But if the relationship were to hold, then it would suggest that there is still upside in house prices. And we already know that house prices have been turning up over the last 4 or 5 months, and this would suggest that that is likely to be sustained until such time as macro-prudential controls might be put in place to try to slow the pace of recovery down. But that is an interesting area of divergence. Another one I think we need to think about is what is happening to some of the sort of key monthly indicators that we receive that give us some idea about what's the state of business and consumer confidence. And we've seen quite significant improvements in those in recent times. So these are just expressed as standard deviations or Z-scores. So the first one here is this is the NAB Business Conditions Index. So it's quite strong, more than one standard deviation above its average. The red dot, most recent reading, the white dot 3 months ago. Business confidence is right towards the upper end of the range, as is consumer sentiment. So these have been significant improvements in some of these indicators. So what does that actually mean, though? Does it have any implications for markets? And what we'll do here is we'll have a look at let's have a look at a little bit of detail on what this has meant in the past. And so what we're going to do here is sort of look at periods where, for instance, NAB business confidence has been in the top quintile, and that's where it is. All of these are in their top quintile at the moment, these economic indicators on the right. And then what we're doing here in the strategy engine is saying, well, what sort of returns, or what's been the following 12-month return or change in a number of market type variables. And so when the NAB Business Confidence Index has been in the first quintile, we can see that earnings growth in the subsequent 12 months to that reading has averaged 12.83%. It's been positive 81% of the time, so 12.8%. What about in all other periods? So the other 4 quintiles for NAB Business Confidence, well, earnings growth has been about 2.6%. It's been positive 59% of the time. So it seems to be quite a significant signal. I get the same thing if I use the Consumer Sentiment Index, first quintile, subsequent earnings growth 14%, positive 84% of the time. And you can see the distribution of returns along the bottom, and that's the frequency of those. So the red bars represent when that is in the first quintile, what happens to earnings. So that all looks good and would suggest, quite a positive backdrop for equities if earnings are rising strongly. But what we also know historically is that when we've had such strong indicators that there's been other effects, in particular on the cash rate. And what we've found is, I'll go back to business confidence, is when that's been in the top quintile, 77% of the time the cash rate has risen in the subsequent, 12 months by an average of 52 basis points. So it's ushered in tightening periods fairly consistently, whereas in all other periods, only about 29% of the time have we seen higher cash rates. So this is interesting because, this is a typical cyclical response, strong economic indicators, usher in a period of tightening. Well, we know that the RBA has been busy trying to remind us that this is not going to occur on this occasion. So this typical relationship is going to be most likely absent, certainly at the cash rate level. Doesn't mean that the bond yields can't rise, but it certainly means that there'll be little tightening, a little prospect of tightening, and therefore this relationship or the impact for equities, what normally happens at this phase of a cycle, strong indicators, what happens the next 12 months, you typically get PE contraction. On average, the PE is contracted by about 1 point in the following 12 months, as opposed to expand by 0.5. And so normally what happens is that the market itself, if we look at returns, the market itself hasn't mattered. So although you've had strong earnings growth, you've typically have also PE contraction. So we think the conditions are a little bit different this time, largely because we don't expect the RBA to move to a tightening phase. So that's the last one I just wanted to refer to very quickly was just the divergence and the extreme readings, I suppose, in wages growth. Wages growth, as we know, is the blue line here, sitting down at 1.4% or thereabouts. The other line here is the deviation of unemployment from NAIRU. And once again, the RBA has talked about the need to get unemployment to NAIRU or possibly below. And NAIRU, if you believe it's something like 4% in Australia, then we've got about 1.5% to go here and possibly beyond. The last time we had wages growth in excess of 3%, so look over here, was really the economy was operating above potential. That is below NAIRU, so an unemployment below 4%, for example. That seems some way off, and hence the sort of supporting that earlier comment around the cash rate staying lower for longer. That's all for this video, and thanks for listening. Thank you.